Hello and good morning to all. This is CA Devang Kothari. So we had started revision sessions for CA final costing subject which is now better known as SCMPE. This video is regarding revising the chapter number 9, that is transfer pricing. Yes, transfer pricing chapter, another very important chapter. Every exam they will have definite one question from this, and this chapter I would say it is again both practical as well as a theory. With every practical question you need to write lots of analysis here. Yes, look, this chapter is almost like decision making relevant costing, such that in every question here, along with the practical calculation, you have to write lots of analysis here. My revision notes that I am showing you here, you will find the link of these revision notes in the descriptions below the video. So let us start with the revision. Chapter 9, transfer pricing. Well, first I have given you some rules, some guidelines here, some notes from my side, that these summary notes cover rules and formulas regarding most common practical questions of transfer pricing. Read this so that you may spend less time in solving practical questions, rather spend more time in understanding how to write analysis. Yes, again at the end of this session, I will tell you how to write analysis there in this chapter. How to write analysis in practical questions as discussed in class. Also use more time for reading the theory. For this chapter specifically, analysis and explanations in your answer are more important than the calculations. The notes given here will help you in drafting proper explanations. These notes will help you in drafting the analysis, drafting the explanations. Done? So here goes. We start with that. First, some initial basics. What is transfer pricing chapter about? Well, when a division of the company sells units to another division within the same company, then this is called as transfer. And the price they charge between these divisions, price charged by seller division from the buyer division, is called as transfer price. Now, in all my examples, I will always create an example where I say that division A is selling units to division B. So for all my examples, consider division A is the seller division, B is the buyer division. Now, each division in my company is a profit center. What does it mean? It means that the performance of each division is measured based on profits generated by that division. So if my company is evaluating division performance by calculating division profit, so each division manager will always want to show maximum profits, will always want to maximize the profits of his division. We need to decide a transfer price. We need to decide such a transfer price such that overall profit of the company is maximized. Imagine you are the general manager of the company. Mr. A is manager of division A, Mr. B is manager of division B. You are the general manager of the company. You need to take decisions from the viewpoint of company as a whole. You need to take decisions that overall profit of the company is maximized and that the transfer price should be equally acceptable to both the division managers. This is the purpose of my chapter. Once again, the purpose of transfer pricing chapter is basically to decide a transfer price. Decide a transfer price such that overall profit of the company is maximized and this transfer price is equally acceptable to both the divisional managers. Done? Yes. Now, two basic rules over here. Rule number one, I say that transfer pricing decision does not affect the overall profit of the company as a whole. Naturally, imagine in my company we have division A, division B, and say total company as a whole. Now the decisions of transfer price will affect the profits of each division. It will not affect the overall profit. For example, sales minus cost will be profit. If the transfer price charged is very high, then for division A, the sales will be more because transfer price is more. So division A, for division A, transfer is a sale. For division A, transfer is a sale, so their sales will be more. For division B, cost will be more. So if transfer price is charged very high, then division A will get more profit because the sales is more. Division B will have more cost, so it will get less profit. Overall impact on the overall profit will be zero. Done. Because transfer pricing is an internal matter, transfer pricing decision will affect profits of each division. Will it affect overall profit of the company? No. This is my basic rule. But in some cases, this basic rule will be violated. In some cases, transfer pricing decision will affect overall profit of the company if demand is based on price. That if demand schedule is given in the question. Why? Think about this. If division A charges more transfer price, then it is more profit for division A. Okay? But because they are charging more transfer price, so for division B cost is more. And in division B, if the cost is more, then division B might charge a higher selling price due to that. If division B cost is more, then division B may decide to charge a higher selling price. If division B decided to charge a higher selling price due to that, then because of this, your demand might be affected. If division B will charge higher selling price from the customers, then with more the price, the demand will fall, and if demand will fall, then overall profit of the company as a whole will fall. Well, this happens only and only if demand schedule is given in the question, only and only if the question has specifically told you that demand is based on price. If that is not given, meaning demand is not based on price, so even if division B will charge a higher price, still demand will not fall, overall profit will not fall. Is that very clear? Yes. So there can be two kind of questions in this chapter. Some questions are the ones where you are given the demand based on price. When demand is given based on price, how do you know that demand is given based on price? Simple. In such questions, they will give you a table like this, price and demand. They will give you a table like this, which is describing price versus demand. So they'll give you a table which shows price versus demand. So if you are given one such table where price demand are given like this, then for such questions, you understand that a transfer pricing decision will affect overall profit of the company. Is that very clear? Otherwise, transfer pricing decision does not affect overall profit of the company. Clear? Yes? Okay. Further, methods of transfer pricing. There are various methods of deciding the transfer price. First 4 methods are full theory methods. Practicals may it is not of much use. Analysis may yes it will be used, but practicals may not much use. Market based method says that transfer price should be the market price. This is used when division A is working at full capacity. If division A is already selling its units outside at market price, and it is working at full capacity for that. Now if division B is asking A to give units, so A will have to decrease sales from outside and give that units to B. So A will want minimum same price as it is getting outside market price. Yep. Cost based transfer pricing, meaning transfer price will be taken as a full cost. Either it is only variable cost or it will be total cost. Whatever is decided between the divisions. It is used when profit is centralized. Profit centralized means what? Means that division wise you don't calculate profit. Now if division wise profit is not calculated, so division A does not want any profit. If division A does not want any divisional profit, then I don't need to charge anything more than the cost. Division A will be happy to get total cost as the transfer price. Third method, cost plus markup, is a method where transfer price will be equal to cost plus some fixed portion of profit. And the fourth method, standard cost transfer price, where transfer price will be equal to standard cost. This means that if division A incurs extra cost, can it recover extra cost from division B? No. What it will charge division B is always the standard cost. If the division A incur any extra cost above the standard, you remember it is called a variance, then that variance is borne by division A itself. This will motivate division A to do cost control. It will motivate division A to keep its actual cost within the standard, because the transfer will be done at a standard cost only. Done? Yes. But chalo, what is more important in your practicals, in your analysis, is negotiated transfer pricing method. Negotiated transfer price method is a method which says that your final transfer price will be negotiated between minimum TP and maximum TP. Minimum transfer price, maximum transfer price. If you remember, all the questions that we solved in class, all questions that we solved in class were based on minimum TP, maximum TP. Yes, so the rule is that I will calculate minimum TP, we will calculate maximum TP, and if the minimum TP is less than maximum TP, then yes, transfer should be done, and the final transfer price should be decided between this minimum and maximum. What is minimum TP? Minimum TP is from the viewpoint of the seller division. It is the minimum price below which the seller division is not ready to sell. So who will decide minimum TP? Minimum TP is decided by whom? By division A. Maximum TP means the maximum price above which the buyer division is not ready to buy. So who will decide maximum TP? Maximum TP will be decided by the buyer division, division B. Yes, so division A will not be ready to sell at any price lesser than the minimum TP. How will it decide that? Well, minimum TP dekho formula, calculation. Minimum TP will be variable cost of transfer, variable cost of transferring units to you. Naturally, because if I am transferring units to you, I am division A, you are division B. If I am transferring units to you, I will want minimum the variable cost which I incur for making those units. Now the variable cost which I incur for making the units to be sold to outside customer might be different than the variable cost which I incur for making units transferred to you. Hence I name this as variable cost of transfer. Of transfer means the variable cost which I incur for the units that I transfer to you. Yes, now variable cost of transfer might generally exclude the variable S&D cost that are not incurred on transfer. Because when I sell units to outside customer, I will incur all types of variable cost, even the variable selling and distribution packaging cost. But if I am transferring units to my own division just next door, if I am transferring units to just the division next door, then I might not incur packaging cost, I might not incur marketing cost, I might not incur some part of variable S&D cost. If it is given that variable S&D not incurred on internal transfer, then you take here variable cost of transfer as the variable cost excluding a variable S&D. Done? Yes. So minimum TP is the variable cost of transfer plus contribution lost if any. Plus contribution lost if any. Now what does that mean if any? Well, if my seller division is working at full capacity, the seller division is working at full capacity, then it might incur some contribution lost. Division A is already selling all its units to outside customer. Now if division B is asking me to transfer units to them, then I will have to decrease my outside sale in order to do the transfer. If I decrease my outside sale in order to do the transfer, then I will lose a contribution on that outside sale. This contribution loss I will want to recover from my transfer. Yes, so my minimum TP that I want will be variable cost of transfer plus contribution lost that I incurred because of the transfer. Yes, this answer here, the summation of this indicates the minimum price which the seller wants, so that it will recover whatever costs incurred on transfer and also recover whatever contribution it lost due to transferring these units internally. Done. Look, this line given here is the interpretation of minimum TP. These three lines given here, I say, is the interpretation of minimum TP. Yes, so minimum TP, whenever you calculate your answer of minimum TP, you can interpret like this. I say that it indicates the price which the seller wants so that he will recover his cost. Also, he will recover the lost contribution. Done. Maximum TP is decided by the buyer division. And for maximum TP, there are two rules that I give you here. Maximum TP is the transfer price above which the buyer division is not ready to pay. Well, how will the buyer division decide that? Two methods here. Dekho. Method 1. Buyer division will calculate the total cost of ready material from outside. He will calculate that if this material is purchased from outside, then from outside when I purchase this material, what is the total cost of that ready material minus the additional cost incurred to make transferred material usable. If outside material, ready material is available at 100 rupees, transferred material will cost me 10 rupees to use it. Now transferred material may there is 10 rupees cost involved for using the material to make it usable, while ready material is readily usable at 100 rupees. So how much will I be ready to pay for transferred material? Well, transferred material I will be ready to pay 100 minus 10, 90 rupees. Total cost of ready material minus the additional cost incurred to make the transferred material usable. Please note, this additional cost here is incurred on the transferred material. Then you deduct that balance. What I get is my maximum TP, maximum price that division B will be ready to pay. What does this indicate? This indicates maximum price which the buyer is ready to pay so that he does not incur cost more than if he buy the product from outside. If I buy from outside, I pay 100 rupees there. If I use from transfer, then I will give you only 90 rupees because I will incur 90 plus 10 to make the transferred material usable. Done? Yes. Or the buyer division will also decide based on net marginal revenue. What is net marginal revenue? Well, net marginal revenue is the selling price of his final product. Buyer division का final product selling price minus the other variable cost of the buyer product. Other variable cost means the variable cost other than the transferred material. This indicates the maximum price which the buyer is ready to pay so that he does not incur a loss on selling his final product. Look, buyer division has to check two things. He will compare that what is the market price of the ready material outside, and he will also compare that if I pay this transfer price to you, will that give me loss in my production or not? So the maximum price that he is ready to pay is the one which is lesser than the market price and which does not make him incur losses. What will he be ready to pay? He will be ready to pay whichever is lower. For example, ready material is available at 100 rupees and it will cost 10 rupees to make the transferred material usable. So this turns out to be 90. Now in my division B, other variable cost in division B is say 60 rupees. Other variable cost in division B is say, for example, 70 rupees. And the selling price of the final product is 150. Now selling price of the final product is 150. 70 rupees is other variable cost involved. So 150 minus 70, maximum 80 rupees it can pay for material, because if it will pay more than 80 rupees for this material, then division B will incur loss. Do you realize that? Yes. So if it will pay more than 80, they will incur loss. If it will pay more than 90, then effective cost is more than market price. Both of these are the maximum TP. Which of this will you use in your answer? Well, final answer will be whichever is lower. Because if I pay 90, then my transfer cost is same as the market cost. But if I pay 90, then I will still incur loss over here. My other variable cost is 70, selling price is 150. So maximum material cost that I can afford is 80 rupees. Maximum material cost that I can afford is 80 rupees, because if I pay anything more than 80, then division B will start incurring losses. If it is incurring losses, it will not do business, it will not purchase anything from you. Done? Yes. So maximum TP is rule 1, rule 2, whichever is lower. So whichever is lower in this case turns out to be 80. So this is just the basic rule. Further, I have given you some extra notes to give you more details of each of these rules, more descriptions in each of these rules. But before that, conclusion dekho. Conclusion is that transfer should be done only if the minimum TP is less than the maximum TP. Transfer only that many units in which minimum TP is less than maximum TP. If minimum TP is less than maximum TP, then for the best interest of the company as a whole, transfer must be done. Yes, transfer must be done if minimum TP is less than maximum TP. Now, if the decided transfer price, the transfer price decided between A and B is already given in the question, good. But this decided TP given is not in the range of minimum to maximum. Transfer price is given in the question, but it is not between minimum to maximum. Then what will happen? Well, then the divisions would not prefer doing the transfer, as it will affect the divisional performance severely. Imagine minimum TP, maximum TP is like this. Imagine as if minimum TP, variable cost plus contribution lost, turns out to be 50. Maximum TP, final answer you have is 80. So my minimum TP 50, maximum TP 80. Your decision is that yes, transfer should be done. But what if it is given in the question that transfer price decided by the company is 45 rupees? If the transfer price decided by the company is 45 rupees, then division A will not be ready to transfer, because division A wants minimum 50. If company decided that no, you transfer at 45, then division A will say no, I will not transfer. In short, if the transfer price decided, if the decided TP is not in the range of minimum to maximum, then the division will not prefer doing the transfer, as it will affect the divisional performance severely. This is when there will be a conflict of goal congruence. Now this is what you also write in your theory analysis. When you write, you can write this, that the decided transfer price is not between minimum maximum. Looking at the minimum maximum, it seems that transfer should be done, but because the price decided is not in the range of minimum to maximum, so the divisions will not be preferring to do the transfer, due to which there is a conflict of goal congruence. What does that mean? Conflict of goal congruence means that the goal of the company is conflicting with the goal of the divisions. Divisional decision is different than the company decision. Division A decided he will not do transfer. Overall company decided that yes, transfer should be done. This is called as conflict of goal congruence. This conflict can be avoided. This conflict can be prevented if the transfer price is decided between a minimum to maximum. Yes, so if the decided TP is not in the range of minimum to maximum, then there will be conflict of goal congruence between divisional decision and a company decision. In such case, company decision is that yes, transfer should be done, but division A will say that no, transfer he does not want to do. This is called as conflict. To resolve such conflict, you have to recommend You have to recommend in your answer that the transfer price should be decided between a minimum to maximum so that it will be acceptable to both the divisions. Done? Yes. Okay. This was the basic calculations under negotiated transfer price. Now under these calculations, I have some important notes and revision to give you. Notice in my calculation here, minimum TP, I said that minimum TP should be variable cost of transfer plus contribution loss. Well, why only variable cost? Why not also fixed cost? Well, fixed cost is not added here because fixed cost is not a relevant cost. Whether I transfer, whether I don't transfer, fixed cost is going to remain same. Now, whether I do the transfer, whether I don't do the transfer, fixed cost is going to remain the same. So fixed cost is not relevant. Fixed cost will be relevant if two conditions are fulfilled. Fixed cost will be relevant in calculating a minimum TP if the seller division has no other external sale and the fixed cost is specifically incurred for that seller division. Imagine if the seller division has its own specific fixed cost which it is incurring only because of the transfer, because seller division does not have any external sale. The entire existence of seller division is only and only because of doing the transfer. If the transferring is stopped, then seller division is stopped, then fixed cost will stop. Meaning the fixed cost is incurred only for transfer. Then it should be added in the minimum TP. Done. But in general, a general assumption is that if nothing is given, then always assume that fixed cost is common fixed cost. Common fixed cost of the company, not the specific fixed cost of any division. And if it is not specific to any division, you have to ignore. Why? Because whether transfer is done or whether transfer is not done, whether division A is existing or whether division A is shut down, in any case, common fixed cost of the company will remain common, it will not change. Done. This will be the general assumption unless they specifically say in the question that the fixed cost is division specific and the division has no other external sale. So in minimum TP, fixed cost will be taken in minimum TP only and only if both these conditions are fulfilled. Look, I have written and between these two conditions. So only if both conditions are fulfilled, only then minimum TP will include the fixed cost. Similarly, fixed cost must be included in calculating maximum TP, in calculating net marginal revenue. Notice right now my net marginal revenue is selling price minus other variable cost only. I did not do minus other fixed cost. Why not? Because again fixed cost is assumed to be common fixed cost. It is not affected whether transfer is done or not. But if the question says that fixed cost is incurred only and only when I use transferred material, if the buyer division is incurring fixed cost only specifically because of the transfer, then it should be considered. Yes, so fixed cost is included in maximum TP if the fixed cost is specifically incurred due to the transfer. But in general, I told you in general, fixed cost is always assumed to be common fixed cost of the company. It is not specific due to the transfer, hence fixed cost is always ignored. In class, whatever questions we did, we always ignored the fixed cost, assuming that fixed cost is common to the company. Done? Yes? Okay. Rule 4 here, I say that if partial transfer is allowed, what does that mean? Partial transfer allowed means that it is not necessary that division A should transfer the full requirement of division B. Division B require 10,000 units. If partial transfer is allowed, then I will transfer say only 5,000 or 6,000 units. Possible? Yes, possible. If the question say that partial transfer is allowed. If partial transfer is allowed, then more than one minimum TP might be calculated. Why? Because you calculate minimum TP on per unit basis separately for each type of contribution loss. For example, if division A has spare capacity, then for the units transferred out of the spare capacity, for the first few units which I transfer out of the spare capacity, for that many units, minimum TP will be only variable cost. And then for the remaining units which I transfer by decreasing external sale, if I transfer units by decreasing external sale, then for that many units, my minimum TP will be variable cost plus contribution lost on external sale. Done? Yes. So you calculate minimum TP separately. Minimum TP you calculate per unit separately for each such type of contribution loss. For zero contribution loss, you have a different minimum TP. For some contribution loss, you have a different minimum TP. Done. We had done many questions like that. We also had questions where transfer pricing was with key factor. Yes, and all those places, if partial transfer is allowed, you will calculate more than one minimum TP. But if partial transfer is not allowed, then only one minimum TP will be calculated. Calculate this minimum TP by taking total of variable cost plus contribution lost, not per unit, total. The word total over here is just written to indicate that you now don't do this on per unit basis. You take total variable cost plus total contribution lost plus any specific fixed cost, if any specific fixed cost of the total transfer units, and then divide the total units of transfer. In that will give you one answer of minimum TP. Well, if you remember, all that we had practiced in the very first question of the book. Yeah. Further, while calculating maximum TP, total cost includes any cost incurred until the material from outside is ready for use in the company. Example, transport cost. I'll show you, chalo. In calculating maximum TP, I've written the word here total cost. Now I clarify that what does this total cost of ready materials mean? Total cost meaning including the transport cost or any such cost which is incurred until the ready material reaches my factory and it is ready to use. The word ready means the cost incurred until it is ready to use. Yes. The total cost of ready material means whatever costs I incur until that material is ready to use. While calculating maximum TP, total cost includes any cost incurred until that material is ready to use by the company. Yeah. If the question asks to explain behavioral consequences, look, in this chapter I'm also telling you how to write your analysis along with the analysis here. If the question asks you to explain behavioral consequences, what does that word mean? Behavioral consequences means you explain that why any division will do the transfer or why that division will not accept the transfer. Why division A decides that yes, he will transfer. Why division A decides that no, he will not transfer. Why division B would decide that it wants the transfer. Why division B would decide that it doesn't want transfer. That you have to explain. That explanation is called as behavioral consequences. Explain the effect of transfer on the divisional profit or divisional ROI and compare that with the divisional profit when no transfer is done. So you will explain the behavior of division A manager, that when transfer was not done, he was earning this profit. Now if transfer is done, he will earn this profit. Based on this, you say whether he will agree to transfer or not. Similarly, for division B, you calculate the profit that he would get before transfer, calculate the profit that he would get after transfer, and then describe that whether he will be ready to do transfer or not. How will he behave when I tell him to do the transfer? That is called as behavioral consequence. While writing all this analysis, you can use this, that the net benefit of doing the transfer in any question of this entire chapter, the net benefit of doing the transfer to the company as a whole is always equal to minimum TP minus maximum TP minus minimum TP. The difference between minimum TP maximum TP is always indicating the net benefit of doing transfer. Done. Yes, we'll see that in question 3, 5, 6 and many other questions also. But in class we had seen them in these three questions. Done. Yes. So later in my revision today, I will be also showing you question 6 again because it is a good practice to revise all the things that I told you here. Done. Yes. Further, if the divisions do not agree to transfer in spite of having minimum TP less than maximum TP, then you need to resolve this conflict. Imagine if minimum TP is less than maximum TP, also you decide the TP between minimum maximum, still the divisional managers do not agree to transfer. Zid pe ade hai. Divisional managers are very ziddy. They are very stubborn. They do not want to still, they do not accept the transfer price still. Then you will suggest methods like these. These are the methods you suggest in your answer. Suggest that the company can use dual rate transfer pricing method or they can use a two-part transfer pricing method. You simply explain a theory of these methods and you show that how will these methods be applicable in the given question. Let me remind you, what was dual rate transfer pricing method? Dual rate transfer pricing method means that both the divisions will record the transfer at different price. Division A wants more price, division B is ready to pay less price. Okay, then I tell division A that you record the sales at more price. I tell division B that you record the purchase at lesser price. Say A is ready to pay, division A is ready to charge 100 rupees transfer price. Division B is ready to pay only 70 rupees transfer price. So how will I show the workings? Well, you show the workings that division A ko bolo that you show sales at 100. Division A will credit sales as 100. Division B will debit cost as only 70. But still the journal entry will not tally. So division B will debit the cost of 70. General company as a whole will debit the cost of 30 and division A will credit sales of 100. This is called as dual rate transfer pricing method. It is in fact the method where the general manager is finally fed up. General manager is fed up of the divisional managers. They both keep on fighting. So finally I said that karo jo karna hai. I just told the division do whatever you want to do. Division A will now record at higher price 100. Division B will record the purchase at lesser cost 70. Difference of 30 I will adjust in my general P&L. Company ka P&L. Yes, difference 30 will be adjusted in the company profit and loss account. Done. This is called as dual rate transfer pricing method. Of course, in this method, your accounting and the calculation work, the accounting work especially, will become very complicated. Yes. For second method, I say two-part transfer pricing method. Two-part method simply says that the transfer price is decided in two parts. Two parts, like for example, I will decide that transfer price will be equal to variable cost plus some lump sum charge. Lump sum means approximate charge on profit, but approximate charge towards the profit. Yes, so I will decide transfer price as variable cost plus some lump sum charge. And as the general manager of the company, I will force the divisions to follow this price. Division A might be happy with this price because he is getting more than variable cost. He is getting some profit. Division B will also be happy with this price because he is getting this price as lesser than the market price. This method is called as two-part transfer pricing method. My transfer pricing calculation involves two parts, variable cost and then plus some lump sum charge. Done? Yes. Okay. Further, if the seller division has multiple products and has a key factor, then for transfer, contribution loss may be of a product other than the product which is transferred. Say I am the seller division, I have 4 products A, B, C, D. You are my buyer division. You require product B. Now, if I transfer product B to you, then I will have to reduce external sales. But is it necessary that in order to transfer B to you, I have to decrease external sale of B itself? No, I will decrease external sale of the product which is last ranking. Say if the product C is last ranking, then in order to transfer extra units to you, I will decrease external sales of C, not the external sales of B itself. In short, when there are multiple products in seller division, then contribution lost because of transfer, whatever contribution is lost may be the contribution lost of a product other than the one which is transferred. Generally, it will be the contribution will be lost of the product which is the last ranking product. Okay? For fixing the transfer price, best method is shared profit transfer pricing method. Shared profit. This is the method where you calculate the maximum overall profit. This maximum overall profit is divided between division A, division B, and then you go reverse to calculate transfer price, which will give exact this profit. So you identify maximum overall profit of the company and divide that between both divisions in some ratio. Which ratio can you use? Well, first priority, you divide the profit in the ratio of divisional profit when no transfer was done. Look, overall profit of the company with the transfer might be more than individual profits when transfer is not done. So overall profit of the company, this maximum profit of the company will be divided between division A and division B in the ratio of their divisional profit when no transfer was done. I can tell the divisions that when you did not do transfer, you were earning profit as 20,000, 30,000. Now if we are doing transfer, then the maximum profit of the company is 1 lakh. Distribute this 1 lakh between the divisions in the ratio 20-30. In the ratio of the divisional profit when no transfer was done. That is the first method. But if that is not possible, profits are not available, then I give you second method, that you divide the overall profit between division A and B in the ratio of cost incurred in each division. Out of the total cost of the company, some cost is incurred in division A, some cost incurred in division B. You distribute overall profit of the company in the ratio of divisional cost, in the ratio of divisional profit, or in the ratio of divisional cost, or you divide that in equal ratio. Ultimately, what you have to do in a reverse cost method, in shared profit method, is this, that you make a profit statement like this: division A, division B, and overall company. Find the overall company profit here. This overall company profit, whatever you get, will be divided between division A and B according to the ratios which we decided. Now that you have divisional profit in A and B, divisional profit in A, you go reverse working, find the transfer sales. From divisional profit in B, you do reverse working, and you find the cost of transferred material. And both these values should come equal. This was called as the reverse cost. This was called as shared profit method. Done? Yes. Okay. Okay. Further, if demand schedule is given in the question, demand schedule means units and selling prices given. Different units, different selling prices are given. Then we need to follow trial and error method. No option. You have to go for trial and error method. You cannot decide by minimum TP maximum. You have to decide by trial and error method by calculating a contribution at each different price, choosing the price which gives the highest total contribution. You choose different transfer pricing. Transfer price equals to this or this or this or this. For each of that transfer price, you calculate a total contribution of the company as a whole. Select the option at which the overall contribution is highest. Done. We have done that again in some classwork questions. You can go and refer that in your classwork book. Also, in many questions, we made profit statement. Profit statement is made in a format. This is a general format of the profit statement. Division A, Division B, and overall company as a whole. Units that are sold external, units that are transferred. Division A might have some external sale as well as some transfer sale. But Division B will naturally not have any transfer sale. It will have only external. Yes. Division A will have purchased material, other variable costs, variable S&D, and some fixed costs. Ultimately, that units are either sold externally or they are transferred. Division B will involve purchased material, other variable costs, variable S&D costs, and it will involve some transferred material also. Cost of transferred material that you write here will be as per the transfer price. Same as the transfer price which is used in a recording transfer sales of division A. That is the reason I said that these two should tally. This and this should tally. Done. Accordingly, that should give you division B minus fixed cost curve will give you division B profit and accordingly overall profit. This is a general format of profit statement whenever they ask you to show division wise profit and overall profit. Done. Yes. Okay. Now, before starting the next topic here, I need to revise. I want to just revise one of the question from your classwork. This question, what I revise, will cover almost, will be taken as an example for all the explanations and analysis that I gave here. Yes. So that will be your example from the classwork, question number 6. Question number 6 from your classwork book in your November 19 batch material. Yeah. We'll see that question. I'll not be reading the full question entirely, but a few things here and there I'll show you. Chalo. The question goes like this. Great Vision manufactures a wide range of optical products, including lenses and surveillance cameras. Division A manufactures the lenses. Division B manufactures surveillance cameras. Okay. The lenses that Division A manufactures are of standard quality and has a number of applications. Due to huge demand in the market for its product, Division A is operating at full capacity. Division A is operating at full capacity. Okay, do remember that. It sells its lenses in the open market at rupees 140 per lens. Now they are operating at full capacity and the market price at which they are selling it is 140. So I can say that this 140 itself becomes the minimum TP that A will want if it will do the transfer. Yeah. The variable cost of production of each lens is 110, where variable cost is 110, and the total cost of production is 125. Look, if the total cost is given, then this total cost as such is not useful in my transfer pricing decision. Because for transfer pricing decision, what I need is variable cost. Fixed cost is always assumed as common cost of the company. But whenever such total cost is given in the question, then remember, you can use this total cost to calculate return on investment, ROI. We'll see, dekho. The total production cost of camera by division B is 400. So division B ka total cost is 400, in which currently division B procures the lens from foreign vendors. So currently, are they doing transfer? No. Currently they are getting it from outside, from foreign vendors, and the cost per lens is 170. So currently division B is getting the material from outside at rupees 170. So I can say that 170 is like the market price. It is the maximum price that division B will be ready to pay. Division B is ready to pay maximum 170 because market price is 170. Yep. The management of the company has proposed to take advantage of in-house production capabilities and consequently a procurement cost of lens would reduce. It is proposed that division B should buy an average of 5,000 lenses each month from division A. So 5,000 units are the units required in a transfer and should buy 5,000 lenses from division A at 120 per lens. So transfer price is already given. Transfer price of 120 is already given. Yeah. The estimate cost of surveillance camera is as below. Surveillance camera is the product of division B. Uska cost you are given here. The other components purchased from external vendor is 150. Consider this 150 as other variable cost. Then cost of lens purchased is 120. Look, instead of purchasing at 170 from outside, now they decide to purchase from division A at transfer price of 120. So instead of 170, 120, 50 rupees less. But because the transferred material is now costing 50 rupees less, that is why the total cost of division B from 400 has reduced by 50. Now it is 350. Done? Yes. Still other variable cost given as a 30 and fixed overheads of that division given 50. Again, assume that fixed cost is a common fixed cost. Yeah. Further, each surveillance camera is sold for 410. This is the selling price of the final product. The margin for each camera is low since competition in the market is high. Okay? Any increase in the price of camera would reduce the market share. If I increase the price of my final product, the market share will reduce, meaning demand will reduce. Are you told how much will demand reduce? No. So you have to answer the question considering that selling price of the final product you will not change, demand should not change. Yeah. Therefore, division B cannot pay division A anything beyond 120 per lens procured. That is what they feel. Great Visions Management uses return on investment as a scale to measure the divisional performance. Now look, they have specifically mentioned in the question that the company will use return on investment to measure divisional performance. Well, that is why now whenever you answer behavioral consequences, you answer that what will be the behavior of the division with respect to return on investment of that division. If the divisional performance is measured based on ROI, then in your answer you calculate ROI if transfer is done, you calculate ROI if transfer is not done, and accordingly say that what will be the behavior of the division. Yes, but chalo, before I explain all that, before I explain what they have asked in the required part, let me show you some general calculation which I have done first. First, I'll make a general calculation towards minimum TP, maximum TP. Minimum TP is variable cost plus contribution loss. Variable cost is 110 for division A. Contribution loss will be 30, so 140, which is the same as the market price at which division A is selling outside. Yeah, so that is the minimum TP that A will want. Maximum TP should be either the total cost of ready material or the net marginal revenue, whichever is lower. Total cost of ready material, exported material is 170. Net marginal revenue for division B is selling price minus his other variable cost. Well, division B ka selling price is 410 minus his other variable cost is 150 and 30. So don't consider the fixed cost. Other variable cost 150 and 30 because fixed cost will be common cost of the company, not relevant. Yeah. So selling price 410 minus 150 and 30 should give you 230. So 230 and 170, whichever is lower, 170 is your maximum TP. So now you notice that minimum TP 140, maximum TP 170. And yes, minimum TP is less than maximum TP. So my decision is that yes, transfer should be done. But the problem in this question is that the company has decided a transfer price of 120. And you notice that the decided transfer price is not in the range of 140 to 170. If it is not in the range, then the divisional managers will not prefer to do the transfer. They will not like the transfer price of 120. So precisely, who will not like the transfer price of 120? Look, definitely division B will be happy with the transfer price of 120. Who will not like this price is division A, because division A wants minimum 140 transfer price. If the company decided 120, then division A will not like the price. They will not agree to do the transfer. In fact, at the price of 120, division A will not do the transfer because his return on investment will decrease. This is what you write in the analysis. Yes, so behavioral Analyzing behavioral consequence means for each division you decide. When division A does external sale, he is earning return on investment of 12%. Profit divided by total cost. Return on investment will be calculated as profit divided by total cost. So his return on investment is 12% in that case. But if he will do transfer at rupees 120, if he will do transfer at rupees 120, then he is incurring loss of 5 rupees. So return on investment is negative. Naturally, division A will not prefer to do the transfer because his performance will be severely affected. Because performance is measured based on ROI, at the price of 120, his ROI will decrease drastically. Yes. So this is my behavioral analysis. Consequently, division A manager would not accept the transfer price of 120 and dish. That other things you can then describe. Yes. Similarly, behavioral consequence of division B. Division B, if transfer is not done, then he is earning 10 rupees profit. That is ROI of 2.5%. But if transfer is done at rupees 120, so see the 50 rupees decrease in his purchase cost. So definitely his profit will increase by 50 rupees and his profit will then become 60 per camera profit. And that gives him return on investment of 17%. So obviously division B will be more than happy to accept the transfer price of 120. Division B would accept the transfer price of 120 because he is getting good ROI. Company is evaluating performance based on ROI. Hence, I showed ROI calculation at both the places. Done. Second part in the question, they're asking analysis. Okay, I'll show you the question. First part, they were asking behavioral consequence of each division. When division A supplies to division B at 120 per lens. Yeah. Part B, they're asking analyze if it would be beneficial to the company as a whole if division A supplied to division B at 120. Is it beneficial to the company? Yes, doing transfer is beneficial to the company. Problem is that the transfer price is not acceptable to the divisions. They are not asking that. They are asking whether doing the transfer is beneficial to the whole company. Yes, it is beneficial to the whole company. Why do I say that? Well, because minimum TP is less than maximum TP. So yes, doing the transfer is beneficial to whole company. In fact, the benefit of the company will always be equal to maximum TP minus minimum TP. How much is the benefit to the company? Well, benefit of doing transfer is this difference of 30 rupees. 30 rupees is the net benefit to the company if transfer is done. That I explain in my second part. Dekho. Also in my second part, I am giving clarification that fixed costs in both divisions are irrelevant because they will remain same whether transfer is done or not. It is common fixed cost. Minimum TP that A must get is 140 and maximum TP that B is ready to pay is 170 as minimum TP less than maximum TP. Therefore, from overall viewpoint, the transfer must be done. Net benefit to the company as a whole for doing transfer is difference of 170, 140, that is 30 per unit. Done. This net benefit indicates what? This net benefit indicates that if the transfer is done, then company as a whole will get 30 rupees additional benefit. Why? You see the calculation here. If transfer is done, then division B will save 50 rupees, 60 rupees. Why? Because when transfer was not done, B was buying from outside. Outside you have to pay 170. If transfer is done, then company as a whole pays only 110. This is like make or buy decision. 170 was the price of buy. 110 is the cost of make. Difference 60 rupees is my savings because of make option. Look, when I describe savings over here, these are savings to the company as a whole, not to individual division. The company will save 60 rupees because they will produce the material in-house. But against that, they will have to sacrifice the external sale of division A. On that division A external sale, they will sacrifice contribution of 30 rupees. So net benefit to the company is balance 30 rupees. 60 rupees is the savings in cost of make. Minus 30 rupees is the contribution of external sale lost. So the net benefit to the company is 30 rupees. Done? Yes, this explanation will always give you same net benefit as the difference of minimum TP minus maximum TP. Always. So I can give you a general rule. I already gave you a general rule over here that for every question of transfer pricing, wherever you calculate minimum TP, maximum TP, if minimum TP is less than maximum TP, then yes, transfer should be done. And the net benefit to the company as a whole is always equal to the difference of minimum and maximum TP. That difference over here is 30 rupees. Yes. Please note that the internal transfer price will affect profitability of individual divisions, but it does not affect the overall company's profitability. Done? Yes. Third, they were asking you that what should be the transfer price. Well, you say that the transfer price should be in the range between minimum TP to maximum TP. That explanation is given over here. Explanation regarding why is minimum TP 140. Explanation regarding why is maximum TP 170. And then you say that final answer should be between 140 to 170. Yeah. Further, they're asking advice on alternative to current transfer pricing method. Instead of deciding transfer price as 120 or between 140 to 170, any other alternate method to resolve conflict of transfer pricing methods. Well, to resolve the conflict, I already explained two methods to you: dual rate transfer pricing method and two-part transfer pricing method. You write the theory of both the methods and then you write that in this question, how will these methods be applied? Done? Yes. And one extra question they have asked that if division A has excess capacity, then what will be the range of price? Well, if division A has excess capacity, then there will not be any contribution lost in division A. No contribution lost, so minimum TP becomes only 110. Maximum TP remains the same as earlier. Range of transfer price will therefore be between 110 to 170. Done? Yes. I consider this question as an ideal question which explains everything regarding how to write analysis in your answer. Yes, how to write that analysis at most of places I described in my revision here. But anyways, later I have a specific point in the summary notes explaining you how to write the analysis. Done? Yes. Okay, we'll go along. Okay, then going further, the last part of the chapter was regarding multinational transfer pricing, or also called international transfer pricing. This topic will be involved when, well, this will be involved when one division is in one country, other division is in another country. Division A is in a different country, division B is in a different country, and they do transfer between these divisions, then it falls under multinational transfer pricing. Now, when the question involves more than one countries like this, then transfer pricing might be affected by taxes and duties of the countries also. It might be affected by income tax and import duties of these countries. For example, if the buyer is in a country with higher income tax, if buyer division is in a country with higher income tax, then transfer price must be set as high as possible. Now, what does this mean? If division A is selling to division B, and if division B is in a country with higher income tax, then in general transfer price must be set as high as possible. Why? Because for the buyer division, this transfer will become purchase. The transfer price will become purchase cost. And if that buyer division is in a country with higher income tax, it will be better that he will show higher purchase cost, because if he shows higher cost, he has lesser profit, he has to pay less tax. Similarly, seller division will sell at higher price. If they will sell at higher price, they will have more profit, they'll have to pay more tax. But the seller division is in a country with lesser tax bracket. So in general, this would mean that you show more profit in the country having less tax, and you show less profit in the country having more tax. Well, that is my rule 1 here. Rule 2, if buyer is in a country with higher import duty, look, buyer country, for the buyer country, this transfer will become an import. If they have very high import duty, then import duty will be charged on the value of transfer. If the import duty is very high, then it would be better that you transfer at the price as low as possible. These are my two basic rules. But well, practically when you solve questions, while solving questions, you will never apply these rules directly, because in questions there will be other things also together, because in the practical questions you might be given both. You might be having the buyer in a country which has higher income tax and it has higher import duty also. Well, if it has higher income tax as well as higher import duty, then no option. You cannot decide based on any standard rule here that transfer price should be higher or lower. Rather, you need to decide by trying out the example. By trying out both the options, you try with higher fixed cost, you try with higher transfer price, try with a lower transfer price, see which option seems to be better. For example, in such cases, देखो, in all such questions of multinational transfer pricing, the decided transfer price is always given in the question. And the question will generally ask you whether transfer should be done or not. The decided transfer price is always given in the question. Transfer decision is taken by calculating the net benefit if transfer is done. Transfer decision is taken by calculating the net benefit. What is the net benefit to the company as a whole if transfer is done? Well, to calculate that net benefit, this is what you do. To calculate the net benefit, you compare for division A what is the benefit, for division B what happens, what is the overall net benefit to the company. For example, when division A will do the transfer, it will change the contribution of division A. It will earn extra contribution on the units transferred, and on that extra contribution it will pay extra tax on that extra contribution. While for division B, if it will obtain units from the transfer, then maybe transferred units will cost them more than the market purchase. So if transferred units are costing them more, so for division B it will be increase in cost because of units obtained from transfer, and on that increase in cost they will save extra tax. So on the increase in cost they will have tax saved. Tax saved is an income, it is a benefit, so I'm showing that as add. Then these four items net effect you find, it will give you the net benefit. Done? Yes, this becomes the general format under which we solved many questions in class. Yes, for every such question about multinational transfer pricing, I suggest you can always follow the same format. Yes, for the division A, you calculate that if transfer is done, what is the change in contribution? If the contribution is increasing, then you pay additional tax on that extra contribution. For division B, if the cost is increasing, increase in cost is something adverse, I show that negative, but on that increase in cost I can claim more tax deduction, so my tax will be saved, so tax saving is my benefit, you show that as addition. Yes, net effect is your net benefit, that net benefit is what you calculate. If this net benefit turns out to be positive, then yes, multinational transfer should be done. If it is negative, transfer should not be done. Done? Yes. Okay, that was regarding multinational transfer pricing. And finally, how to answer analysis in this chapter. Well, just like in decision making also I had given you guidelines regarding how to answer analysis, here also I am giving you guidelines regarding how to answer analytical part in this chapter. Dekho, first rule, give explanations for minimum TP and maximum TP every time. Every time when you calculate minimum TP, you give explanation that why is your minimum TP only variable cost, or why is your minimum TP variable cost plus contribution lost. So you give examples, you give explanation that why have you taken contribution loss or why you have not taken contribution lost. Similarly, in case of maximum TP, you give explanation that why is maximum TP taken as the market price of ready material, or why is it taken as net marginal revenue. Why do you take whichever is low? Why do you take the maximum TP out of these two options only? Yes, you have to write that explanations. Why do you take whichever is lower out of that? That also you need to write. Yes, explain the logic behind the rules of minimum TP, maximum TP that I just discussed in my video earlier. Yes, so I gave you formulas for minimum TP, maximum TP. I gave you logic behind the formulas. That logic you have to mention in your answer, in your analysis. Number one. Secondly, also explain what does this minimum TP and maximum TP indicate as mentioned in the rules of calculations above. I'll show you that for minimum TP, maximum TP, for both of them, I have written here that what does it indicate. I've written here that minimum TP indicates what we discussed that here. I told you use that in interpretation of minimum TP. Similarly, maximum TP indicates what? I've written them here. So if your final decision was to take formula 1 as maximum TP, then you write that it indicates this. If your final decision was to take the second approach as maximum TP, then you write this as interpretation. But you have to write this indication, interpretation in your answer. Yes? Okay. So explain what does this minimum TP, maximum TP indicate. Interpretation you have to write. And then a third, give your suggestion that the decided transfer price must be between minimum TP and maximum TP. You give your recommendation that you should decide a transfer price between minimum and maximum. Also, say that if it is not between this range, then what will happen? If it is not between the range, then what will happen? Which division will like the price? Which division will not like the price? Like in that question 6, what I showed you here, the given transfer price was less than minimum TP. Well, in that case, what will happen? In that case, division A does not wish to do transfer. Division B will be happy to take the transfer. Write that in your answer. And because of this, you write that there will be conflict of goal congruence. If this happens, there will be conflict of goal congruence. Explain what does that word conflict mean. Yes, conflict means that divisional decisions will not be same as the company overall decision. Division A decided he will not do transfer, but from overall viewpoint of company, yes, transfer should be done. Yes, this is called as conflict of goal congruence. Mention that in your description here. So you also say that if the decided transfer price is not in the range, then what will happen? What will be the response of each division in that case? Which division will like the transfer? Which division will not like the transfer? If he does not like the transfer, there will be conflict of goal congruence. Done? Yes. If the question asks to make profit statement with and without transfer, many questions will ask you to do that. They'll ask you to make profit statement with transfer, without transfer. I gave you format of profit statement earlier. This was how you make a general format of the profit statement. If material is transferred to division B, then they will obtain transferred material here. If it is not transferred to division B, then they will get purchased material there. Yes, so they might ask you to make profit statement with or without transfer, both. If they ask you profit statement, then also analyze that why is the profit different in case of with and without transfer. Maybe with transfer they have better profit, maybe without transfer they have lesser profit, or you identify for each division that with transfer, without transfer, what is division A profit, with and without transfer, what is division B profit. Accordingly, what will the division prefer? In short, you have to mention the preference of the division manager, and you mention that with respect to the profit that they earn. You mention that division A is getting better profit when a transfer is not done. Mention that division B is getting better profit when transfer is done. Whatever be the case, write that in your analysis. Which division will prefer, which division is getting better profit, in which case, transfer or don't transfer, everything you write in your analysis. Look, all these rules will help you accumulate more things in your analysis. You have to write analysis in your answer. Yes. So you also analyze why is the profit different in case of with and without transfer. Analyze for each divisional profit individually and also for the overall company profit. For division A, transfer or not, what gives better profit? Then you describe for division B, transfer or not, what gives better profit? And then you describe for the overall company, transfer or not, what gives better profit. Yes, and give reasons for the difference in profit. Accordingly, explain the benefits of doing transfer. Yes, all that you write in your answer. Further, Any transfer price between minimum and maximum TP will resolve such conflict and promote goal congruence. This will be your conclusion in every answer. And if the transfer price is decided between minimum and maximum TP, it will mostly resolve the conflict and it will promote goal congruence. Goal congruence means that divisional decision, company decisions will come same. Yes, but if the divisions do not agree to this transfer price, this price between minimum and maximum, then the last option, the very last option, is to use dual rate transfer pricing method or two-part transfer pricing method. Give the description of both the methods, give the basic theory of both methods, and also mention that in this question how can they apply dual rate or two-part transfer pricing method. We saw that today in question 6 itself. That question 6 was an ideal which shows you all types of analysis here. Done? Yes. Yeah. Once again, do remember, I keep repeatedly telling you that what is more important in my revision sessions here is not just the calculation part. I am not focusing on calculation. I'm giving you rules of calculation, and most important, I'm giving you how to answer the analysis. Done? Yes. That's all with the chapter. Thank you very much. New chapter we'll be having in the new video. Bye bye.